Hey harvesters, and welcome to the channel where we run simple and straightforward options trading to generate income. My name is Matt, and in today's video, I'm going to go over the trades I executed for November 24th. I'm going to be talking about the covered calls and cash secured puts. I usually like to keep about 90 to 95% of my trades as covered calls or cash secured puts. I do run some speculatives from time to time, but ideally most of my portfolio is just covered calls. So in today's video, I'm going to talk about the trades I executed today. I'm going to talk about the project State of the Union. I transferred over from investing into high income ETFs over to my own options trading because I just did not like the performance of the hedge funds or like a Yield Max, Roundhill doing it for me. I didn't like the NAV erosion. I didn't like how much money the money looked like you're getting a lot, but it was actually your own money. And the investors that were investing into the money, they were just paying you back that money. Felt like a little bit of a pyramid Ponzi scheme, but that's besides the point. But I've been running my own options trading since April, and then you're going to see how much money I've generated after 157 trading days. You actually might be surprised at how much we have done. And then lastly, I'm going to talk about the trades I plan on executing for tomorrow. So let's get the ball rolling. For anyone that is a returning subscriber or viewer, you guys know me. The first thing I like to show on my channel is the Robinhood portfolio value from the Robinhood screen, because I'm going to use these numbers later and then use them for my spreadsheets. Currently marked at $209,938.97. Guys, today was a bit of relief in the market. It was quite nice to see my account recover $18,000, right? So I was pretty happy about that. And that's not even most of my buying points. That's not even where most of my buying points were for the shares I own. So we still have a lot of room to go. But ideally, a little bit of relief. I'm super happy about it. And hopefully this trend can stay until the end of the year. But that's the Robinhood screen. Let's head over to the Excel spreadsheets and I'll start talking about the trades. Before I head over to the exact trades that I ran, I want to talk about the harvester rules I set for myself. This is my trading philosophy. Every time I go into a trading day, I keep these 4 principles in mind. For red markets, I will never sell a covered call below my cost basis. I'll extend out expirations. So what does this mean? So the way I trade is every time I buy shares, I buy them in 100 share chunks. So, and every time I buy the 100 shares, I buy them at different price points. So for example, QQQ, I have the 605 buy-in, 606, 609, 622, and 627. So each one of those 100 shares, I treat as an individual silo of money. So how I trade the 605 is different than how I'm going to trade the 622. So what does that mean? If the market is red and it's below my cost basis, I will choose strike prices that are at my buy-in. I will make less premium doing this, but I will almost guarantee never incurring a loss. I will get bad premium, but if premium is an issue, then I can just extend the expirations. Usually I run QQQ daily, but I will just push them out to a week. The market is continuing blood red. I can even do expirations 2 weeks out, and then I can adjust accordingly week over week. All right. Rule number 2, for green markets, I usually sell covered calls $1 to $3 away from at the money as long as the market is above my buy-in. So why do I not use a delta versus a dollar mark? Because for me, I don't think delta completely tells a story, because whenever I run my covered calls, depending on how hot the market is, I'm going to choose a different strike price, because either want to capture the appreciation because the market's moving pretty quick, there's a lot of volume going down, or am I going to prioritize premium? So there's like that choice and trade-off. And for me, like sticking to a specific delta for covered calls doesn't make sense for me, because the way I view my covered calls is I wheel and deal them. I don't mind them getting assigned quite frequently, because then I'll just turn around, run cash secured puts at a relatively, close to the money mark so I can get them assigned, and then restart running covered calls immediately. So that's how I run my covered calls. When we're talking about cash secured puts, rule number 3, I choose a delta of 0.2 or 0.3. Cash secured puts is the only time I really do look at deltas, because the way I operate my cash secured puts is I don't actually want them to get assigned, because whenever I run them, most of my cash is already tapped out into owning hundreds of shares for my covered calls. So when it comes to my cash secured puts, I actually use Robinhood margin. But let me explain. When you run a cash secured put, you're basically using collateral until the option is assigned. So theoretically, you're using Robinhood's money. An investor is going to pay you upfront premium to lock in shares at a specific price if the market goes down. But then if you never get assigned, you never incur margin interest. So what does that mean? If I choose a strike price, that is relatively far away, but yet enough premium. And then if I do get them assigned, they're at a competitive rate. I think that's a win-win in all regards. So I usually will surge into margin for discounted rates, especially for like the red market we had this last 3 weeks. You consistently saw me choose different strike prices. Like 3 weeks ago, I bought 100 shares at the 627 range. Then a week later, 622. Another week, 609, 606, 605, and etc. So basically, I consider this like my spring loaded. In a red market, you're basically loading up a spring, and every time you're buying shares at a cheaper rate, eventually the market is going to reverse, and you let go of the spring, and the spring blasts up. So that's kind of the thought process I have whenever there's a red market. I start loading up shares at a better and better buying point, choosing 0.2 to 0.3 deltas and getting a better buying point. And eventually the market's going to reverse, and then I'm just going to make a ton of money on the way up. And number 4, and this is probably should be number 1, but buying good investments. I only like buying the top 10 stocks in the US S&P 500 and ETFs. So ETFs, QQQ, SPY. I have traded IWM, and if your account is small enough, you might have to run IWM if you want to run options every day. But I don't really like IWM because I'm not a big fan of the small cap stocks. There's a ton of upside opportunity, but there's also an opportunity that you can lose money running options on that. If you look at the long-term trend, IWM is fine. But for me, I would rather just choose like 5 good stocks. Usually I trade like Oracle, Amazon, NVDA, Tesla, and then QQQ and SPY, depending on the day. So I like to choose the winners of today. I don't look at speculation. There might be times where you can buy, cheaper shares. You can buy like 100 shares of, a stock for like $700 and then run premium against it. But I have been bit before running like covered calls on that kind of strategy where, hey, there's this up and coming stock, eventually it's going to be projected to be a super big powerhouse, but then eventually, it went bankrupt, and then guess what? You lose a ton of money. So for me, I only invest into the winners. Why would you invest into anything else? So those are the 4 principles or the 4 rules I have for my trading. So now let's head over to the spreadsheet and talk about the actual trading. Now that we are at the Excel spreadsheet, I'm going to be talking about my trades that I executed for the 24th. So we did 4 covered calls of Tesla because I have 400 shares, 5 covered calls of QQQ because I have 500 shares, 1 cash secured put on QQQ. That's a daily. Oracle did a cash secured put. It's a weekly. And then I actually bought a call of Meta because I thought the price of Meta to what its earnings normally is definitely undervalued. So I wanted to take advantage of an opportunity. So let's dive into it. For my Tesla shares, what I was talking about from my harvester rules is I had a 450 buy-in price, and then the market was trading at 402. I don't want to incur a $48 loss per share. So, 100 shares, that'd be $4,800. So ideally, I'm going to choose strike prices that are at my buying cost. So what does that mean? I chose a strike price of the 450, bagged $65 of premium. This option is going to expire at the end of the week. So we will see where Tesla's going to be at. It opened today at the 402.16, and then it closed today at the 417.52. So we will see if the market continues to trend in a green direction, or if it'll be neutral or it'll be negative. We'll see. Only time will tell. And the same concept applies for my other hundreds of shares of Tesla. So I had a buying point with another 100 shares of Tesla at the 442.5. Market's at the 402. Doesn't make sense to sell below my cost basis. I don't want to incur a loss. I don't know if Tesla will recover up until my strike price. So therefore, I chose a 442.5 strike price that netted me $115. So you guys get the gist here. So then I had a 440 strike price. That is that buying point is way above where the market's trading. Don't want to incur a loss. Chose a 440 strike price, bagged $156 of premium. For the 420 shares, I pretty much did it at the money. Market opened up at the 402. I didn't think that Tesla was going to skyrocket, almost, $15 a share. So I pretty much did it, chose my strike price that was at my buying point. That netted me $620 of premium. That was a juicy premium, and I was pretty stoked to get that. But if you look at today, the premiums are even higher because that's closer to my actual strike price. So if I waited, I would have been patient. But if I would have been patient and waited, I could have made more money. But end of the day, nobody knows what tomorrow is going to hold. So I like to always take my money up front. The longer the expiration you can do, the better. But I only like to keep them at a week at a time, 2 weeks maximum. So that talks about all of my Tesla shares. Now we're going to start talking about my QQQ shares. Usually for my QQQ, you could run this ETF as a daily, and that's usually what I like to do. However, because my buying points are way above where the market is currently trading, like my buying point, 626, the market, it was trading at the 595 at the open. So for 500 shares, I ran weeklies. So my buying point, 626.78, chose a 627 strike price, made $7. 622 buying point, chose a 622 strike, $20. 609 made $228 premium, chose a 609. Because the market was so far away from my buying points, I decided just to run weekly, lock in the money up front, and then I wouldn't have to worry if it'd go up or down. So then 606 strike price, or 606 buy-in, shows a 606 strike price, $317 a premium for a weekly. 605 buy-in, 605 strike price, $387. You guys get the drift here. All of these options are currently active because they're week-long. They're going to expire on Friday. Don't forget, guys, Thanksgiving is this Thursday. That day is off, so there's only 4 trading days. Well, now 3. That Monday is over. So you have 3 days to collect as much premium as possible. Now let's talk about my cash secured puts. So I ran a cash secured put on the QQQ. This was a daily. When the market opened at the 595.29, it looked relatively strong. The market looked green. So I decided to run a covered call that, or a cash secured put that was relatively close to that buying point. I would have been totally fine if I got 100 shares assigned at this 593. I think that's still a steep discount, but that was a daily. I made $116. And guess what? This expires worthless at the end of the trading day. Bag that $116, and guess what? That money is freed up, so then I could trade that exact trade tomorrow morning. So I can theoretically make another $300 or maybe $345 on top of all this money I've already made. Like I said, expired worthless. Then we did an Oracle cash secured put. I chose a cash secure, or I choose a strike price of the $200. Oracle hasn't been at $200 for quite some time now. And I thought, even if this were to get assigned to me, it would be steep discount. And I made $415 off of a $20,000 collateral investment. That was a ton of money to lock in for for a stock that I think has plenty of upside. So initially when it opened, it was at the 196.49. It closed at the 200. So it's slowly, trending on its way up. Hopefully at the end of the week, it does not get assigned. Don't really want to buy the shares, but if I did, $200, great price, still active. And lastly, let's talk about the Meta. Yeah, so let's talk about Meta. I don't usually do buy calls. And for me, I only run buying options, probably 5 or 10% of my portfolio. I don't like doing anything more because for me, this is the way I think about it. I just put $6,000 on this option. I had to pay out of pocket about $6,000 to run this option. Instead of me having to put out $6,000, I could have just been running cash secured puts on Meta, and then by June 2026, I probably would have made more money than this option is going to make. There is so much, I believe there's so much upside with Meta because it was trading at 750. It's a good stock. It has great revenue. And right now the price to earning is so competitive that I was willing to take a gamble and run about a 6-7 month option on Meta because I think there's plenty of upside. Paid about $6,000, and we will see how much return I'm going to get from this option. I chose the 650 strike price. Meta traded today at the 598.73. When I bought this option, Meta was at $613 a share. And ideally, for me, if I make like 20 or 30% off this option, I'm pulling my money out. I pretty much made my gain, and I don't like leaving money on the table. I rather take it up front. If this could potentially go up to $750 a share again, that could be like a $10,000-$15,000 option gain win. However, that's not guaranteed. So for me, whenever I see like $2,000 or $3,000 from this option, I'll probably close it out, no big deal, and then move on with my life. The end of the trading day, guys, $2,446 buying and selling, or mostly selling options on good stock. A lot of QQQ shares. Tesla is debatable depending on who you talk to. I personally like Tesla. I think they have a lot of upside with their robotaxi, their XAI. And then whenever they build that robot, the Optimus, and they mass produce it, I think that's going to be one of their biggest hits. So I think their stock price is just going to blast into the stratosphere. Cool. With that being said, let's head over to the other side of the spreadsheet and talk about the project State of the Union. All right, guys, we are at the favorite part of my videos. It's the Project State of the Union. This basically reaffirms that am I doing the right trades or the wrong trades? So let's dive into it. Looking at November 24th, I made $2,446 of premium. There was no appreciation gain. That was straight money up front in my pocket on a Monday. Right now, the count is at $210,000, as we saw from the Robinhood screen. And since trading my own options back in April, I've made $73,407. We are definitely within the realm of possibility of maybe hitting $80,000 by the end of the year. If we look at that as a percentage based off my initial investment, money I brought over from 2024 in the Robinhood, and some of the money I placed in, that's about a 39.88% return based off of my investment. And if you look at that change in percentage, that's about a 10.86% change in value. So that was quite nice. I'm super happy how today went, and hopefully we can keep that trajectory until, forever. My trade win percentage, winning at 98.73% of my trades, 155 winning days, 2 losing days. And those 2 losing days were just chalked up to investor inexperience. It's okay. We're all going to have them. But as long as you learn from your mistakes and don't repeat them, that's the point we're trying to get across here. Because if you keep having losing days, you obviously are doing something wrong, and we need to adjust course. So I like to track a couple of metrics on my channel. Some of them, one of those metrics is the average premium I am generating per day. It's about $467. If we look at that as an average weekly premium, I'm making about $2,200, about $2,224. As a monthly premium, $8,635. That number is definitely going to increase when November completes, because once we head over to the monthly numbers, you're going to see how much money we have made. For 2025, I wasn't going to trade for a full calendar year because I started my own options trading in April. And then so I'm only really going to have about 8 months, 39 weeks of trading. But I decided to project out what some potential returns would look like. And based off my trading performance, what did I do? I took the average weekly premium I'm generating, multiplied it by 52 because there's 52 weeks in the year, and we came up with $115,672. So if I stayed consistent, trading exactly the same way, if the market conditions stayed exactly the same, I would make about $115,000 a year. That is quite good if you were to ask me, for running trades that take about 15 minutes or less in the morning. If you look at that as a percent return based off my investment, it's about a 77% return. And if you look at from where I started back in April to where the project has progressed, I was averaging early on in the project about, maybe about $70,000. But the more money I made and the more money I put into the account, that number then progressed to $115,000. Now imagine if my account's at $300,000, $500,000, $1 million. Would I even be able to trade the same way? That's going to be debatable, and I still have years before I get to that mark, but it's definitely something to start thinking about. And that's all those numbers I wanted to talk about there. Let's head over to the weekly values. Taking a look at the weekly values for the last week of November, it was the first trading day of the last week, made $2,446 as was mentioned earlier, but we've hit the 4-digit club 12 weeks in a row. So that means that's $1,000 or more. We are being more consistent, and it's definitely in a turbulent type of market conditions. This last 3 weeks, it was a red market, but I still was able to make 3,500, 4,700, 2,200. So what I'm saying is I'm taking the money up front is definitely working. And then once the market recovers back to, pre-correction, basically pre-3 weeks ago, my account's going to be looking real good, guys. Looking at the monthly tracker for November, this is what I was mentioning earlier about the monthly average. We hit $12,968. If I run one cash secured put tomorrow, that's going to net me about, $32. We've hit $13,000. We made $13,000 in a red market. That's kind of wild to think about. So I was pretty excited with how my trading performance for November went. I feel like I'm becoming more and more confident. It's about 8 months, and I just got my system locked down. I don't really want to change anything. People keep throwing different comments in there about running futures this or future that. It's like, why change something when it works? Shout out to you, 50 Delta. For the yearly tracker, we already talked about it. We made about $73,407, and we are about $6,600 away from hitting $80,000. Guys, if I trade, a couple more times this week, about 3 more days, lock in another $300 to $400, that would be phenomenal. But then all I would need for December to hit that $80,000 mark is $6,000 more, $6,300. I think that's totally doable, especially with my last 3 months being super productive. Cool. Now let's head over to Robinhood and start talking about what I plan on doing for tomorrow. All right, guys, now that we're at the Robinhood screen, let's talk about the plan for tomorrow. So right now, if you look at my buying power, there's a little red or a yellow caution symbol. Nothing really to worry about here. That's just saying that I don't have that much buying power available, but I actually have, $376,000 left, but it's because my options collateral was getting close to being maxed out. So if my shares get assigned, I still would have plenty of buffer, but for whatever reason, Robinhood likes to freak you out with this caution symbol. So there's that. When 9 a.m. Pacific Standard Time rolls out, all of my options that expired today, that expired worthless, it's going to free up that money. So then tomorrow morning, I plan on running another cash secured put on the QQQ. So let's take a look at what that would look like. Because the only thing I could really do tomorrow is run a cash secured put, because the rest of my capital is tied up in all the other shares, 400 shares of Tesla, 500 shares of QQQ. I don't have much more leeway to produce any more income. So it's just going to be one cash secured put until the end of the week. One cash secured put daily until the end of the week. Excuse me. Let's head over to QQQ. And let's see what some of the numbers look like. So to run a cash secured put in Robinhood, sell put, and kind of how I mentioned earlier, the way cash secured put works is an investor is going to pay you an upfront premium so that they can offload their shares in the case the market nosedives. So basically, once you choose that strike price, you're obligated to buy those shares at that price. So say, for example, I choose a 605 strike price. If the market by tomorrow or whenever I choose the expiration expires at 605 or lower, then I have to get assigned these shares. That means I have to buy the shares. And the only thing you need to bring to the table is enough collateral to buy 100 shares of this stock or this ETF at that strike price. So for a 605 strike price, I would need $60,500 of collateral to run that option. But QQQ is trading at this 605.20, and this is the only time I really look at deltas. Kind of what I mentioned earlier in my harvester rules, I like to choose a delta of 0.2 to 0.3. So let's start looking, $3 away from at the money is about $127 of premium. I would be willing to choose a better strike price so that if they get assigned, it'd be easier for me to sell. Still about $106 of premium, so I'm pretty stoked about that. Delta of 0.25, that's ideally exactly the delta I'm looking for, somewhere between 2 and 3, 2.5. So what delta means is this is the likelihood of this option executing. So there's about a 25% chance. So I like the odds of this not actually hitting, but then me also locking in $106 of premium. I'm going to be taking that every single day because, guys, there's about 250 trading days a year. If you make $100 a day trading, that's $25,000 a year. And then you have a couple of decent wins on, spread out throughout the year. That's a ton of money. That's all you really need to maintain a decently sized portfolio and be consistently trading successfully. But yeah, that's the plan for tomorrow, guys. 601 strike price, and life is going to be good. I really don't have anything more to bring up in this video. So, stay locked in, guys. Stay harvesting. Matt out, and I will see you in the next video.